A driver runs a red light, 4 seconds of noise, then silence and paperwork. The other driver has no insurance, and your car is a write-off, totaled. Now there are two numbers in your life: what the car was worth, $24,000, and what you still owe on it more. The car is gone, guess what isn't? This is a case file about who pays, the driver, the insurers. A fund you've never heard of, or you open the file. Start with that word, totaled. Totaled is not a mechanical verdict. It's a financial one. An insurer compares two numbers, the repair bill and what the car is worth. When the repair bill crosses a threshold, the car is declared dead. The threshold depends on where you live, somewhere between half the car's value and all of it. Many written-off cars could be repaired, it just doesn't pay. Your car didn't die in the crash, it died on a spreadsheet. Ledger 1, what the car is worth. The insurer doesn't ask what you paid. A valuation database prices your exact car against recent comparable sales, age, mileage, condition, trim. The answer is the car's market value, the second before the crash. And market value has been falling since the day you bought it. Rule of thumb, 10% gone in the first month, 20% in the first year. Around half within 3 to 5 years. Then one more subtraction, your deductible. A few hundred off the top of every payout. Ledger 1 closes at $23,500. Now meet the number that refuses to fall with it. Ledger 2, what you owe. A car loan is not attached to the car. It's attached to you. The car is only collateral. The loan is a contract with a lender, and contracts don't care what happens on the road. Loans have their own physics. In the early years, interest takes its biggest bite out of every payment, so the balance falls slowest, exactly when the value falls fastest. Take a 6-year loan with nothing down. 1 year in, you still owe about 86% of the price. The car is worth about $80,000. Ledger 2 stands at $25,800. Now the crash forces the two ledgers to meet, for the first time. Here's the part almost nobody expects. That insurance payout you've been imagining. It's not addressed to you. Whoever finances the car holds first claim to that money. So the insurer typically pays the lender first, $23,500 straight past you, into the loan. You get whatever is left over. Look at the ledger. There is nothing left over. You still owe $25,800. Your insurer paid $23,500. And here is the number the file was hiding, the difference. $2,300. Yours. No car, no keys, and a monthly payment that still arrives on the same day it always did for a machine that no longer exists. The car is gone, the loan isn't, and that's the version where everything went right. That $2,300, that was the best case. Real loans are rarely clean. Taxes, fees, dealer add-ons, and the unpaid balance of the last car get financed on top of the price. Real loans start above the car's value on day one. In one large market, roughly 1 in 4 drivers trading in a financed car still owes more than the car is worth, often by several thousand. And one country's financial regulator has a name for rolling old car debt into the next loan: the auto debt treadmill. Now the honest footnote: this channel deals in real arithmetic. On a clean loan, the gap is a couple of thousand at its worst, and it closes around year 3. The danger zone is front-loaded. Survive the early years and the trap unwinds itself. This file's crash came in year 1. So send the bill to the driver. They caused this. The law agrees they should pay. But here's what the file says. Depending on where you drive, anywhere from 1 in 50 to more than 1 in 4 of the drivers around you has no insurance. Most aren't villains. They're people who couldn't afford the premium, which means they usually can't afford your car either. You can sue. You'll probably win. Then you'll discover why lawyers turn these cases down. A court can order the driver to pay in full, but if they own nothing the law can touch, that order is paper. The law caps wage deductions and shields basic income by design. Their rent outranks your repair bill. Even a successful collection arrives in small installments over years. Your loan payment arrives every month, and if the driver simply flees in some large markets, roughly one crash in 8, there is no defendant at all. Not even a losing one. So who actually writes you a check? There's a ladder. Rung 1, your own policy. Mandatory insurance protects everyone else from you. Cover for your own car is almost everywhere, the optional line. Collision, casco, fully comprehensive, whatever your market calls it. It pays no matter who hit you, minus your deductible, up to market value. Rung 2 exists only in some places. Dedicated cover for exactly this crash, a patchwork, and often capped low. Rung 3, the guarantee fund. Most countries with mandatory insurance run one, a payer of last resort, funded by the industry. But these funds are built injury first. For your car, they can charge their own deductible. Cap the payout, or refuse hit-and-run car damage entirely unless someone was seriously hurt. And in one country, the mandatory scheme covers injuries only. No fund pays for the car at all. There, your own policy is the only backstop. Notice the pattern. The worse the driver behaves, the weaker your car's claim gets. Time to close the file. Who pays? The driver, a judgment on paper. Chased for years, and you often get back only a fraction. The fund, injury first, capped, and it charges you its own deductible. Your insurer pays the car's value, then folds the loss into next year's premiums. A small charge on every policy pays for it. Every insured driver quietly prepays for the uninsured ones. And you. The deductible, the gap. The replacement rental, it stops days after the settlement offer, not when you find your next car. Sometimes a higher premium at renewal, for a crash that wasn't your fault. One more line in red. Skip payments on that orphan loan, and the machinery is ruthless. In some markets, one missed payment can knock 100 points or more off a good credit score, and the mark stays on file for years. The same system that couldn't reach the uninsured driver reaches you perfectly. Everyone pays, you just pay twice. Now flip the file over. 5 moves while they're still cheap. 1. Carry own damage cover. It's the only rung of the ladder you control. 2. Mind the gap itself. Gap cover exists in most large markets for exactly this hole. Buy it from an insurer. At the dealership desk it can cost up to 10 times more, financed at interest. 3. Cancel it when its job is done. Once you owe less than the car is worth, around year 3 on a clean loan, the gap is gone. You can often claim back the unused premium. 4. Don't build the gap in the first place. 20% down roughly cancels year 1 depreciation. Or buy a 2 to 3 year old car. The steepest depreciation was someone else's. 5. Once a year check 2 numbers, what the car would sell for and what the loan would demand. The day the first number wins, you're out of the trap. Case closed. 1 crash, 2 ledgers, and a bill that lands on whoever understood their contract least. You can't control who runs the red light. You can control which of those 2 numbers is bigger when it happens. This file is one case in a series about who really pays, when systems fail, when cover lapses, when the fine print wakes up. Which case should we open next? Tell us in the comments. The most asked case wins. And if files like this are worth your time, subscribe. The archive is open.